We define active management as using skill, analysis and judgment to build a portfolio of investments which are each expected to deliver an attractive rate of return, and also avoiding investments which are expected to deliver an unattractive rate of return or where the return is not understood. Active management is not the same as being highly active. Active management implies building a portfolio that looks very different to the index, whereas being highly active implies trading, and we believe that a trading mentality is not consistent with an investing mentality. And in general, we're skeptical of portfolios that deliver a high level of turnover. We favour active managers because of the extra return that a good active manager can deliver. As a rule of thumb, a good active manager should be able to deliver around 2% per annum ahead of a broad market benchmark. To identify good active managers, we first need to find the managers that build portfolios which look very different to the index. Next, we find the managers that also hold companies for a very long period of time, and we do this because there's significant evidence that shows that these two characteristics lead to strong returns. And finally, we need to meet the investment managers and understand their investment approach. The traits that we look for in good active managers are an ability to describe clearly and concisely what it is that they do. We need to agree that that approach makes sense for their asset class. The investors need to sit in an environment that they control, and that often leads us to invest with boutique investment houses. And finally, we need investors who will stick to their discipline throughout all market cycles. Performance of active managers is definitely cyclical. Markets experience fashions and fads, and an investor who follows a discipline will find that there are periods of time when their approach is not in fashion. The good investment manager will limit the damage when their style is out of fashion and then let the sails out when they have a style tailwind. A passive approach can be more appropriate than an active approach. For example, when you've had a period of long market weakness and assets have been sold indiscriminately, the passive ETF or fund will capture fully the subsequent upswing in markets, which an actively managed fund may not be positioned to do. Also, if we can't find a good active manager in an asset class, our alternative and fallback position is to hold a passive fund or ETF. And we would do this in preference to an average manager because the average manager is unlikely to outperform. Smart beta products give investors the ability to allocate to factors such as value, growth, momentum or quality, and as such offer another set of tools in the investor's toolkit. But like any investment product, it's important to understand the underlying holdings and characteristics of any smart beta ETF or fund.